Okay. And one last confirmation. Kat, you can see my slide and you can hear me okay, correct?
Correct.
All right. Welcome, everybody. Thank you for being here. This is session 4, I think. I'm not even sure what day it is at this point. But this is our Shift Happens series. And considering what happened late last week, over the weekend, and early in this week in the lending environment, we kind of called some audibles, and rather than digging into more, the buyer and seller operations sessions that we had, we wanted to talk about creative financing. On Monday, we did a session where I kind of showed you behind the curtain why that's a problem, why some deals aren't closing, why jumbo loans, condo loans, hard money loans have pretty much just disappeared. The non-QM stuff and no doc, low doc, like a lot of that stuff's gone. So it's, fortunately that doesn't represent the majority of our market. So most people's deals are still closing. Rates have settled out. The Federal Reserve did make a lot of drastic moves and threw a lot more money at it. A lot of good things, but we are coming into an environment where deals won't close. And it's, as I said on Monday, there's a buyer's market and a seller's market. And I think what we're heading into is for, we have our economy on, and to prevent our market from stalling out, I think this is a professionals market, meaning that the people who have the most tenacity and can think most creatively and aren't willing to accept that you can't do that as an answer, that will find a way to keep their market moving forward, find a way to get their clients what they need, find a way to do a deal when and every investor says there's no deals to be done. Creative financing is one of the best tools that I know to really, jumpstart a market or to keep it moving, to keep some momentum. So I'm going to show you 7 different strategies that I've used I think can be helpful in the environment. These are things I've to coach people as deals are coming up, as they're trying to have to completely switch finance strategies, both investors and realtors. Most hard money lenders have gone away. The ones that are left have really tightened down their LTV requirements. They'll go to 50 to 60% of the after repair LTV. But a lot of them just simply won't originate right now because they don't know what their recourse is. And the CARES Act helped in a lot of ways, but it had a lot of unintended consequences that are rippling through our financial markets and mainly in real estate lending. So if worst case scenario, the Fed, we get everything on track and we don't have to use these tools. But if that's not the case, like if we end up, like if the market does end up stalling and lending tightens even more, I just know that you guys at least have, a foundational knowledge of what these things are. So you can get them, you can deploy them when it's needed to save your deals and get your clients what they're looking for. So just some facts and disclaimers here. I'm not your broker. I'm not your attorney. I'm just a guy trying to help you out and I guess inspire you to think outside of the box rather than accept what other people might be accepting. The facts are some of those lending programs I just talked about have disappeared. They're not there. I do hear a few lenders saying that they can still get a jumbo loan done. I haven't yet confirmed that, but I have talked to hard money lenders. There's apparently a couple in the country that we're still funding as of 2 nights ago. I haven't actually, I've seen more of them not show up for closings. Investors are calling me like, what do I do? This guy he can't close. We're at the table. So lending standards, some have already tightened. So LTV requirements, credit score requirements, debt to income ratio requirements, that's all going to tighten, similar to what you saw in 2008. Now we have a much healthier real estate market now, but the challenge now is not actually the real estate market. It's unemployment and the lack of, the moratorium on evictions and foreclosures, or excuse me, moratorium on rents and mortgages, that there's just nobody's sure what their recourse is. So that's why you're going to see it tighten. It's going to be a more competitive market for qualifying for financing because it's harder for the originators and servicers to sell that paper. But even if you have limited loan options, even if it gets worse before it gets better, I want to enable you to be able to create financing and keep your market moving forward. So teach you how to leave an existing loan in place, wrap one around it, or have the seller carry a second. I want the whole intent of this is to try to show you how to be nimble, and instead of accepting that you just have to sit at home and watch Netflix until something changes in your market, you can actually go find things that will move your market forward. We obviously live in the United States, so we have 50 states, and all of them have their own real estate laws, and even within that, some counties are different. So I'm not going to be sharing contracts. I'm not going to send you my paperwork. I'm here to help, but I'm not here to create liability for myself. I'm not an attorney. I've worked with a lot of attorneys, and I have a lot of experience in real estate, but and you might find yourself eager to, have everything in place after this training. I'm just going to tell you it's not going to happen. I'm doing what I can to help as quickly as I can. This is not going to be a full-blown master's course. Like, we're going to talk about 7 strategies over an hour and a half to hour and 45 minutes. And some of you're going to have questions that probably won't get answered today. However, if you should find a mentor, as I teach in Probate Mastery, anyone, creative financing is an amazing tool, but it's very easy to create liability for yourself and for your clients and the people you're serving. So you should have a mentor. If you've never done these types of deals, someone should look over your shoulder, and that someone should probably be your real estate broker, your real estate attorney, or an investor that can mentor you, someone who has experience in your state and your market. Obviously, attorneys are going to be the best. If you don't have a creative real estate attorney, I would suggest talking to investors in your market, especially ones that are buying foreclosure homes. If they're working the courthouse steps at trustee sales, their attorney has dealt with a lot of messy title issues and has had to do some creative thinking and things like that. So typically the attorneys who are representing the investors, doing their closings, writing their private mortgages, those guys will understand everything I'm going to talk about here today. They can help you craft your language and your purchase agreements, and do this the right way. So rather than me giving you one blank form and saying, oh, this will probably work, I would rather show you how to find someone that can really protect you and mentor you in your market. So go to your local RIA, talk to the cash buyers on your list. If you are an investor, you probably already know who this attorney is. But my advice to you is, if you have a title company you really love and they don't do this kind of stuff on a day-to-day basis, they're more, commodity housing, probably not the place to run these through. You may have to, if they have an attorney on retainer, you can sit down and talk with them. If this is over their head or they say it's illegal or wrong, nothing here I'll show you is unethical or illegal. But oftentimes in our industry, when people, including brokers, when they hear something, when they're, instead of learning something, they just discount everything that they've never had experience with. I have had to have like brokerage meetings to put these deals together. I've had to bring both brokers to the table and explain to both parties, the buyer, the seller, and the broker on each side, exactly how it's going to come together, and literally teach the people who are supposed to be at the top of the industry. And then once everybody understood it, they're like, this is genius. Like, how did you think of this? But don't be surprised if your broker tells you that you can't do these things. If they tell you can't, you just shouldn't, or you should sit down with them and say, well, let's find a way that we can do it. But make sure you have their blessing if you're doing this on their paperwork, if you're using a brokerage contract. If you're an investor, you can do it with the attorney and have your own paperwork. If you are a broker, or excuse me, you're in brokerage and your broker doesn't want you to keep transactions alive using creative financing, one thing you can consider is if you have an LLC, if you have an investment division, like an investment arm of your business, just move it over there. Most all of this can be done without a real estate license. You can do it as an investor. There's different ways. You could be a consultant. You can be a principal in the transaction. There's lots of different ways. So all that said, if you don't feel comfortable doing this on your own, that's okay. But find somebody to help you, because it is easy to miss things in this that aren't covered, and you don't have a standard contract to cover you. So you do have to think for both sides and make sure you're mitigating as much risk as possible. all that boring stuff out of the way. So we're going to start with, I showed you guys a matrix on Monday that I'd put together over the weekend that was just 7 strategies that I've seen that are very useful in this environment. We'll kind of go from the most conventional to the least. So the first is just a second mortgage. So the way I've broken this down is how it's used, what are the advantages, what are the disadvantages, and what other notes do I think you need to see. And then we're going to look at this from a buyer's perspective and a seller's perspective. Um, sorry, I was just checking our questions, comments over here, guys. So we'll start with a second mortgage. This is simply a second note that's carried by the seller or the lender sometimes to bridge a gap, usually because a borrower came up against LTV requirements. So for example, they can only get an LTV of 80% for a conventional loan, but they don't have the cash to cover the other 20%. So they need to come up with, and for whatever reason, qualify for FHA or USDA. So they need to come up with that 20%. So this is an opportunity where the seller or the lender, even a third party lender, step in and carry a second for that 20% LTV. Now, I understand that I'm assuming you understand the risk of being in a second position mortgage. If a market corrects and you have a distressed sale, that second mortgage might get wiped out. So it is a much higher risk than having a first position mortgage. Oftentimes, if you have to go through a foreclosure, enough equity is wiped out in the sale that the second lender is kind of left holding the bag. So a lot of times, like in short sale scenarios, you'll contact the second position lender first, make them an offer. They'll usually release for pennies on the dollar because they know if they play hardball, there's not going to be anything left to go around. So this is more of an emergency tool that's kind of the way I use it. For example, we had a excuse me, a $580,000 property at the closing table, which required a jumbo loan. Rhonda had this in Georgia on Friday. I think it started Friday last week. And they had a jumbo mortgage approved. Everything was good. The lender didn't fund. They didn't show up. So they pulled back. So one of the suggestions I told her was, if the jumbo loan market has dried up, what happens when financing goes out of luxury markets? Typically prices will correct down until someone's so motivated they just can't take it. They'll pay cash, or they'll let the value drop down to $509,000 where they can get a conventional loan. So supply and demand, when you take away the supply of financing, then the demand drops and then prices will follow. So my advice to her on that one was, rather than scrambling trying to find to find a replacement jumbo lender when they might all not have that tomorrow anyways, was, what if your seller, they had $100,000, I think it was around $100,000 in equity. So what if your seller could change, if you could convince the buyer to drop their loan down to a $509,000 conventional loan, have the seller carry a second. At that point, they get like a $30,000 check at the table, and then they have a $7,000 note that they carry. $71,000 note, I think, is how it worked out. But anyways, the way the math worked out is they were taking a $70,000 risk to protect $100,000 in equity. So my advice to her was, have them lock in that price today, because if lending goes away on these more expensive assets, what does that usually mean? Prices are going to fall. And in this environment, I mean, it's a lot of variables are different than in 2008, but unemployment is going to be high. People's investment accounts, retirement accounts have been greatly impacted. So in that price range, I expect you'll see prices soften across the board. So this was, the advice I gave her was, have your seller catch the falling knife and carry some of that risk. They can make more money over time. Worst case scenario, they lose 70 grand because this person defaults and they get wiped out. There's nothing left on the second mortgage. But that's where a tool like this can be useful, is to step in and basically put a deal back together. So for the buyers, if a buyer has very little cash and or if the first mortgage rates are really high, so they can originate a second with a lower rate. Like this doesn't really apply in this environment, but if let's say they get a conventional loan with a 6% rate and then they negotiate with the seller to carry a second at a 3% rate, so they get a blended rate that's lower and gets them into where they can afford it. This is for sellers who really need to attract. I mean, the only time this is really a great tool for sellers is when they're trying to protect equity and attract buyers in a market where values are correcting. Advantages for the buyer is they can afford more house and have that lower blended rate that I mentioned earlier. And for sellers, the benefit is they can limit their downward risk and catch the falling knife and probably end up netting a lot more. Disadvantages to the buyer is their debt to income ratio could be too high to buy anything else. So if they do this and because they're using two different loan programs, they can get that extra debt. But that could create problems in other areas of their life. So when they go to buy a car or to, refinance their second home or rental property or something like that, then it could create a problem because this will drive their debt income ratio above the threshold for lenders on other purchases. And then a lot of times that second mortgage is not going to be a 30-year term. It's going to be shorter term money. So a lot of times that the payments on the second are going to be, it's going to push their monthly debt service up. So the things you need to be aware of is if you use a second mortgage, is it on a 30-year amortization schedule? The best way to do it, in my opinion, to not drive your buyer's price up is to put it on a 30-year amortization schedule with a 5-year balloon. So they have 5 years to get through a situation like this, refinance both notes into a single note when jumbo loans are back available. And if as far as notes on the buyers, I'll go back to the disadvantage for the seller is they're carrying risk. So instead of getting all their money at the closing table, they get a good chunk of their money at the closing table, and then they carry that note, which it carries some risk with it. It also carries some reward. If the buyer can live up to what their commitment, then they're going to get their principal plus the interest back. So they can actually net more on the sale if everything goes well. For the buyer in conventional lending, it can work as long as your buyer's financially healthy. You don't want to put distressed buyers into this. This is a really good tool for the higher end, higher price stuff with people with higher incomes, especially if we know their income is going up, if they're aggressively investing in a market like this where they're going to see big returns that might not be on their regular income. And then seller and investing, this can really help builders and flippers. So if you're finding yourself now where you've got 2 or 3 projects underway, especially if you're in that higher price point, rather than lowering your price, you can say, well, if a realtor ever looks at you and says, as the seller, if someone comes to you and says, well, sorry, my buyer no longer qualifies. That's great. What do they qualify for? I'll cover this. I'll cover the rest with a second. So keep them on this house instead of letting them go look at less expensive houses. It's what they wanted. It's, the reason they don't qualify now is because the shift happened underneath of them. But if they still love this house and they still want it, then as a builder or as a fix and flip investor, you can step in and say, okay, well, so if you still qualify for 200,000, I'll carry a note for 100,000 on a 30-year AM with a 5-year balloon at 5% interest, and you take away the objection. So if you're stuck holding inventory right now, especially if it's your money, this could be a good way to, as if buyers aren't qualifying, this could be a good way to move your inventory off your books. Jennifer had asked, can you get a copy of this? So yes, we are going to give you, we'll give you a PDF handout of each of these so you can have it. And guys, I put this slide deck together. Kat put this slide deck together really quickly with the spreadsheet I made. So if you see typos or anything, I'll try to clean it up before we send it out. Next is a no interest mortgage. So this is just a first position mortgage, but with a 0% interest rate. And this is, again, really common in a shifting market where sellers need to really attract buyers. A lot of times it could be in a high rate environment, but even now, like with financing tightening, they don't have to qualify. So this can be very attractive, and it can be a way for you to move your inventory. So for sellers, flippers and builders right now that are like got caught holding the bag, and you think prices are going to correct in your market, or you think buyer activity is going to dry up, this could be a good way to attract people out. So put this out as a listing with, this house is listed at $400,000 with a 80% LTV, owner financing with 0% interest, and put a 5-year balloon on it. Same way, give them a 30-year AM, but balloon it at 5. That way it gives them time to refinance, but you can sell at today's price because you sell on terms, right? You make it easier for them. No, their closing costs are way cheaper. Buyers who have saved up money for a down payment. So if they're self-employed, they just sold something, and they sold out at the top of the market. Maybe they pulled out of the stock market, and maybe they're accessing that $100,000 in their 401k that they have 3 years to pay back. Those are good scenarios where a buyer who might find themselves stuck right now someone who went through a divorce is another good example. Their credit got destroyed in a divorce, but they've spent the last year rebuilding that. They've got strong income, but because of their credit score, even though they have the income and they might not have a high debt to income ratio, they can't qualify for a loan. So this is something where you can put somebody like that into a brand new home at today's price, protect your seller, and get your buyer something that he doesn't have access to. But not many people are offering stuff like this. Usually at any given time, you have 1% or less of inventory on MLS will have any kind of creative financing ability, because most people are selling so they can go spend that money somewhere else. They're not investors. But especially with builders and investors, if you can give them whatever cash they can get right now because their tenants aren't paying them and they're trying to figure out their own financial situation, they can be really motivated to do things like this in markets like this, and your buyers can be really motivated because life didn't stop for them. All the reasons that they needed to buy a new home, a bigger home, a home in a new market is still there. It's just a lot of other inconvenience around it. So the advantages to the buyer is if they can't qualify for traditional loans, they can still buy a home, and even a more expensive home today versus moving down to something they could qualify for today, having to sell that, and then find a much nicer home in the future when their credit score comes up and prices could have risen on them. So it can be very advantageous to the right buyers. The seller advantages, so flippers and home builders can move inventory in a bad market or in a worsening market and just lighten their own debt load. So right now, everybody that was holding a lot of debt is a little bit panicked. You've got some builders that build as many as 1,200 houses at a time, and some of these bigger developments where they're really swinging for the fence. So this is where tools like this, if you're in if there is development in your market, if those builders are holding inventory and it's not complete, go meet with them and say, hey, why don't we either step in and be like, I'll be your listing agent and I can do this, or if you're representatives, move your buyers a brand new inventory and negotiate a 30-year amortized no interest mortgage with a 5-year balloon, and just know that you need to help them refinance. But you can create some inventory for your buyers. Disadvantages, and not a whole lot of disadvantages to a buyer on this. Well, one thing I forgot here is they're probably going to have to have a pretty good down payment. A lot of sellers aren't going to take the risk without some form of down payment. If the market was clearly correcting and a seller knew he was going to lose 20%, then he might say, the hell with it. Like that's going to be lost money if we don't do this deal. So I'll do 100% financing, 0% interest, 30-year AM, 5-year balloon. Just here's the blue pen, just sign it. But it's not quite that environment. So what you're probably going to see is they're going to want something like maybe 20% down as standard in traditional lending. But if they're looking to do a deal, they should be flexible. Maybe you can get 10% down. But the disadvantages are they need to have some down payment. But honestly, to put a person into a home, like into this home, you want to know that they're financially strong anyways. The seller's disadvantage is they have to carry risk until the balloon or the refinance takes place. I don't even understand my own parentheses there. I see. So when the loan balloons, the most likely structure to the way you put this together would be with that 5-year balloon. Notes on the buyers, they should have a plan for refinancing or paying off the debt. Just make sure they understand what they negotiated. So if you have a 5-year balloon and in year 4, they decide to buy an arm, and just travel the country for a year because they're burnt out, you need to tell them, you need to remind them, make sure that they know what they're getting into, what their obligations are. Excuse me. And if a seller wants to do this, but wants to further mitigate their risk, they can actually structure this as a contract for deed instead of a first mortgage. So you could offer a contract for deed on a 30-year amortization with a 5-year balloon and 0% interest, which means the seller is actually going to continue to hold the title, which in this environment we'll talk about in a bit, but it's way safer than just recording a first mortgage, because who knows how long a judicial foreclosure process takes when the courts are choked with months and months of backlog. So something to consider is on the seller side, they may actually be better off doing this as a contract for deed or a land contract. Owner finance. So this is, when assets are held free and clear and the seller can put a first, this is more of a traditional first. It's a great tool when lending is tightening, prices are falling, or when buyers and sellers lock on price. So I find that a lot of times, negotiations, if what I call gambits, if you leave on the table all these different terms, and then when you get deadlocked on price, you can negotiate on terms. If you have failed to do that and you've got a buyer and a seller that are firm in their positions and all you have left to negotiate is price, a lot of times those deals are dead. Owner financing can be a way to break those deadlocks. So when you're stalled on price and the buyer just will not pay another dollar and the seller won't take anything less, and you still have a gap, if you can show the buyer how they can save a ton of money on closing costs like loan origination, appraisal, everything that it takes to get the conventional loan, and then show the seller how they can get a higher price. And a lot of times you can use a tool like this to actually sell homes at a premium because it's price or terms, pick one, right? So for buyers, typically this is for buyers who can't qualify for traditional financing or who are willing to buy a better house based on the fact that they're getting it on terms. So they'll pay a higher price because the financing terms are attractive and it makes that house just as affordable as some others. For sellers, if a market's shifting and they absolutely need to get that top dollar, this is one that I use in probate when possible. If it's important that a family gets every last dollar, but they have plenty of time, as long as the asset is rolled out of probate and you can put use owner financing, put a first mortgage on it at an attractive rate, then we don't have to negotiate price. We can, waive all contingencies, sell as is, where is at a full price offer. And they're going to make even more money over time. They'll be getting 5 years of interest payments before the balloon, or some people will even carry them, full term. So advantages to the buyer is underwriting is a lot easier. They look a seller in the eye and say, here's who I am. What else do you need? They can bring pay stubs. I have people do a regular, I think it's called a 1003, the traditional lending application. So I'll have them fill out a complete 1003 and authorize me to do a criminal, credit, and sex offender background check. And that's kind of how we underwrite a lot of these for sellers. And I'm like, okay, here you go. What do you think? Do you trust him? Do you think he'll do what he says? And we kind of let the seller underwrite it. But it's certainly a lot easier underwriting. Buyer can qualify for whatever they're comfortable with and whatever the buyer and seller are comfortable with, and they're going to ultimately pay a lot less for that loan, a lot less in fees. And then the seller advantages, they can sell for a higher price and end up making a lot more money in the longer term, and they can move assets when others aren't. So if we're in a shifting market and people are, sellers are just waiting, and they, when you saw this in 2008, 9, 10, 11, all these beautiful houses are sitting here. The sellers aren't, they're not desperate, so they're not dumping the price, but nothing's really moving. This is one of those tools that you can use to start to break that log jam loose and be like, you know what? We're going to go out and find buyers with these attractive financing terms. So yeah, even though this might be on a street with 5 houses for sale, they're all in the same price range. Which one's going to sell first? If you open this up to buyers who went through a divorce and have like that last scenario, they've got strong cash flow, they've got a steady job, they just haven't rebuilt their credit score and they can't qualify for a loan, or they just took a bath in the stock market and all of a sudden, they lost 35% of their net worth that was in investment accounts and brokerage accounts, but they didn't sell their position. So we know if they hold on long enough, that's coming back. We also know that they're an investor, so they will probably have more money in the future, more likely than not. So these are great tools that you can use for situations like that, where you can take almost a stale market, put a buyer in there that should be able to qualify for financing based on all the things I just said, and make a transaction happen. And then go to the neighbors and say, hey, you know how we sold your neighbor's house? Well, let me show you. Would you like to put yours on the market? The notes for so disadvantages for the buyers, again, it's pretty limited here. The only thing is, there may not be an escrow account. So when they write, principal, interest, taxes, and insurance and in a single mortgage check, that's the only disadvantage I can really see. Is you just need to make sure that they're paying the property taxes and they're paying the insurance, and that's covered, and that the lender is named as additional insured on the policy. The seller disadvantages, they're only getting a down payment and they're waiting for their equity. So until the note's paid off and the risk is satisfied, the note is satisfied, then that risk goes away. So that's the only real disadvantage of them, is they have to carry some risk until they make more money. So a buyer can get a lower rate if they agreed to shared appreciation clause. So in the note, you can sweeten the pot for the seller and get them to give you a more attractive interest rate if you put together if you give them an equity share on the back end. So you can talk to your attorney about this. It's if you look up shared appreciation clause, you can find some stuff about this, but basically say, here's the value we bought the house at. When we sell it, in exchange for an interest rate instead of 8%, for an interest rate of 5%, we are willing to split the difference between this basis value and the sale price. We will give 5% of that net to the seller upon settlement on disposition. So if you've got an investor who's selling this and he's a pretty savvy guy, this is going to be pretty attractive. It's like, okay, so I'm going to take a risk in taking a lower interest rate over a 5-year period, knowing that when you sell the house, I'm going to get to share in that equity and the appreciation that you've built while you're paying me for my mortgage. And then the seller can negotiate graduated payments, or a balloon payment to incentivize the buyer to refinance. So graduated payments, like you could leave the rate the same, but imagine in order to get the buyer to qualify, if they're let's just say this is a new doctor moving to town. So you've got a 26-year-old that is moving here as a resident. They have an employment letter from the hospital, but they haven't gone to work yet. So we know that they're going to go to work with a healthy income. We know that their income is going to increase over time, but they can only afford so much right now. Well, as a seller, I want X for my house. I need to make at least that much money. So what if you can think of it as, when you see a regular amortization table, you have principal and interest, and it's kind of a flat line, but the principal, the interest is heavy on the front and then tapers off over time. Think of this as where your payments would be less in the beginning and they would grow over time. So what this can do, this and having a balloon that's 3 or 5 years out, this becomes an incentive for the buyer to refinance, because each month their mortgage payment goes up, or each quarter maybe those mortgage payments go up, or they know that in 3 years they're going to have a full call on the note and they have to refinance it. So these are things that can create some additional benefit for the seller by getting it refinanced faster. And it also mitigates some of the risk, by getting more money in a shorter amount of time, you have less risk. So there's some things that you can do, even, some even more creative overlays that you can use in these owner financing scenarios that really make it attractive. Like shared appreciation clause and graduated payments, or using balloons. Next would be a contract for deed or land contract. So this is where you're negotiating the price and terms of your agreement, everything up front. And then the buyer is going to make whatever that amortization schedule is. The buyer is going to make those payments until the last one's made. Then the seller will actually transfer title. These aren't real common, but they are really neat. And right now, this is a really interesting way for investors to keep deals together. So talk about the buy side first. So buyers who can't qualify for bank financing or agree to pay a higher price due to the fact that they're buying on terms. It might be a higher price, but overall about the same cost. And then the sellers who are looking to get top dollar, or because they think values are going down, or if they want to hold on to the asset and keep getting the tax benefits of that, and then also mitigate their own risk in case of default. What I mean because of that, so imagine a landlord bought a house, or an investor bought a house this year, and the market has shifted. Instead of trying to flip it on MLS, now he's going to go out with an offer of a contract for deed. So he's going to offer it at 3% financing with a 30-year amortization, on a contract for deed, and you may put a balloon in there to speed this up. But in theory, if they're willing to go the full term of 30 years, they would hold that note and make that interest payment. So some of the benefits there for them is they continue to get the depreciation benefit of that asset. They can get the tax benefits because they still hold title. Now they still have to pay, they still have to include the tax payments from the buyer and make sure those are paid. They still have responsibility as well. If the buyer would default, they are in a much better position in this judicial environment, because they don't have to go through with a foreclosure. The contract for deed, they're still holding title. So it's much easier and much less expensive to recover these assets than it is an asset where you transfer title and hold a note against that. The advantages to buyers: underwriting is easy. They can qualify for a much larger loan, and the fees are way less. That's pretty consistent throughout all these. Seller advantages is that they can sell for a higher price, make money on the interest, and they can also sell when other inventory just simply won't sell, because they're appealing to to buyers who are being told no. I tell you other scenarios where these can work really well. So I learned this from some clients when I was doing the creative financing deals back in 13 and 14. I didn't really understand Islamic banking principles are much different than the U.S., and they don't really want to participate in our banking system, the more traditional. So I found that I would meet a lot of folks who, business owners who made a lot of cash. They didn't want to even talk to a U.S. bank and mess with that, because they have more of a shared risk financial model. And these can be really attractive for them. They can make additional payments. Like a lot of those guys, they would buy a house and have it paid off in 2 or 3 years. Everybody would just pitch in and plow their income, into extra principal payments. And they would, actually in the last one of these I put together, I did one like this, and he was a truck driver. And he gave me a $75,000 down payment. I only had to carry a $10,000 note at 8%, and I only did it for a 12-month term. But I mean, he had been saving that money. So there are people out there who won't qualify or aren't interested in traditional bank financing. When you list a property like this or advertise a property like this, it can make it very attractive because of their culture, because of their situation, because of their values. So some think about, like, there's certain, like, subsets of the population that will really love these. Entrepreneurs really love these because it's like, I can close in a week. I don't have to worry about paying all these financing fees. I don't have to worry about qualifying or showing people my tax returns. If discretion is something your buyer's looking for, this can be a great tool. And then the seller has the best of both worlds. You mitigate their risk of recovering asset, or making the asset more easily recoverable. They end up making more money over time, and they can sell their house right now in this environment. So the only real disadvantage is to the buyer is that they're not holding title. And one of the ways you can mitigate some of this is by requiring the seller to actually close into a land trust. So it 100% protects you, but just think of a scenario where a buyer and seller agreed to this, and seller was John Doe holding title as John Doe. Well, John Doe gets in a drunk driving accident and kills, 3 people in a car accident, and the family sues him for everything he owns, and they come at him with one of the strongest litigation attorneys there are. Well, first thing they're going to do is say, what did John Doe own that we can get for you? And they're going to go looking for assets. Now, there's nothing to 100% protect against this, but if the asset is in a land trust, then you have an attorney as the trustee, or I would recommend having an attorney as a trustee, so you have attorney-client privilege. So if that same scenario happens, they go looking for assets in John Doe's name, or looking for entities that he owns in John Doe's name with a matching registered agent. This is just going to be a land trust. It gives you a lot of anonymity. You don't have to disclose who the beneficiaries are, and if you disclose who the trustee is, and that's your attorney, that's John Doe's attorney, then he doesn't have to tell them without a subpoena or without being forced. So unless they're really, really savvy attorneys, they're probably not going to find this asset. So protects the buyer losing the title, for something that's out of their control, like frivolous lawsuits or other unforeseen liabilities on the seller side. That's something I haven't seen a lot of people do. I pretty much, I made that up when I was on these deals here. I'm like, man, what if? Like, I always assume, like, I'm empathetic to both sides, and I'm like, well, if I was in this position, I would want to know what happens if the seller gets killed by a dump truck, or if he gets sued. And I think the best level of security I've been able to offer is requiring the title to be rolled into a land trust before the buyer starts making payments is about the best you can do. You could also do things like, you could write specific language that says the seller agrees to have a blanket umbrella policy, or, something like that. The seller disadvantage, buyer default is really the only real risk that's here. But if you take a reasonable, like a good sized down payment, you can lower that risk. I mean, if a buyer has already put 20% down and they've already made payments for 2 or 3 years, and something happens like right now and they're out of work, they're unlikely to just walk away and give up, because they've got skin in the game. So in that case, and the other good thing about this is you can be nimble. So that this is between the buyer and the seller. There's no secondary market to worry about. This loan hasn't been sold 17 times and now sitting on the Federal Reserve's balance sheets. This is a local deal. These two people can renegotiate at any time. If they both see benefit in renegotiating, you can do that, re-record a new note, and start over. So if they were to lose their job and they had already made that down payment, the seller might say, all right, you know what, you've already given me a lot of money and you've done what you promised. Let's go renegotiate. Let's re-amortize this. We'll do it on a 15-year at the same interest rate, whatever. So there's, even with the risk that the seller does have, if they can still think creatively, even when things go sideways, these are a lot easier to deal with. You can basically, you're just more nimble. Notes on the buyer side. So the buyer needs, like with the other things, the buyer needs to have a plan for refinancing. Or they need to, or if the seller agreed to go full term, like if they have really agreed to carry the note for 30 years, that's amazing. That means you're an amazing negotiator and professional. But if not, then if there is a balloon in there, then they need to have a plan for what their next move is. How are they getting out? And then, like I said, I would encourage you to assist from the buy side of the table that the asset is put into a land trust. So there is just an extra layer of protection there. And again, on the seller side, so the seller, they really should be willing to mitigate the buyer's risk by putting it in a land trust, because it basically, it hides in a sense, hides the asset. But the other thing is they don't have to pay transfer taxes. So here in Virginia, like when I form a land trust, it's $500, and that's for all the legal fees, recording, and everything. So it's certainly a lot cheaper than me closing on something, taking title, and then having to sell it. I can just go roll my own asset into a land trust, and you don't have to pay transfer tax. Now, some states do require transfer tax on like $0 transfers and stuff like that. I know Pennsylvania is one of those. I think if you do this in Pennsylvania, you have to pay the full transfer tax. But that's a contract for deed. So next is assumption of mortgage or subject to. Assumption is not that common. Subject to is more common in the investment space. But basically what this is when the buyer is taking title to the asset subject to the existing mortgage remaining in place, or they're assuming the mortgage and taking title. With subject to, the seller is going to keep the note on their credit, but they're going to get immediate relief from all the payments, maintenance, all the other expenses. FHA, VA, and USDA loans are still assumable, but now the buyer must qualify. Like up until, I think it was 1982 or 1983, VA loans, you could you could assume the loan with no application. Like you could just assume anyone's VA loans. It's not that easy anymore. Now you actually have to qualify. So if your buyer already doesn't qualify, then that probably is not the best option. And I've kind of lumped these two together. So assumption and subject to are different things, but if you have a buyer that doesn't qualify, then they're not going to be able to get a loan assumption because they weren't able to meet the same underwriting standards. So we would take them more of a subject to. So for buyers who can't qualify or just don't want conventional financing, and they don't want to pay, the high lender fees and underwriting, this can be good. For a seller who just needs a quick solution, they have financial distress or emotional pain like divorce or anything, job loss, but they just need to get the hell out of this situation, and they don't need their credit right now. So they're not going to buy another house. They're not going to buy a new truck, or they don't need their credit immediately. This can be a great way for them to get away from their pain, and for a buyer to get in with very little money and very little fees, and everybody wins. So the advantages to the buyer is, in this environment, they're going to get a pretty attractive interest rate. Anything that's been originated recently has a great rate. It might not be as good as today, but they're still historically great rates. No real underwriting, no real fees. It's not going to show up on their own credit. It won't count against their debt to income ratio. And a lot of times they're getting built-in equity with it. So if a seller, paid $150,000 for the house, and now they only owe $100 because they've been paying it down, but they just need town like today. They just need their bills are paid because they just need to go check out and start over. This could be a situation where the buyer could pick up $50,000 in equity just for essentially taking over the payments for the seller, so they can get away from the emotional and financial pain they're running from. The seller gets immediate relief from all the debt service, holding costs, expenses, and they can go do whatever it is they need to do that's making them so motivated. Disadvantages. So because of the fine print in these notes, when you read a note, anything after like the early 90s, you're going to see what's called a due on sale clause. So when title transfers and the lender finds out about that, they do have the right to actually trigger a due on sale clause, which will usually call the note due in full within a 30-day period. Well, if your buyer doesn't have enough money to qualify to buy a home, chances are they're not going to be able to pay a lump sum. They're not going to come up with $100,000 in 30 days. So things that you can do, like that's something the buyer needs to be aware of. Now, I've actually never seen anyone get a note called and subject to. Even in defaults, I know people who held homes subject to that unfortunately had the default, but they still didn't call the note. They just went ahead and moved to a foreclosure process. But if a buyer can qualify to, if where did I leave off? So the dual and sale clause is in pretty much every note. The ways you can mitigate the risk of a lender seeing that. What I like to do with these is so you purchase the home subject to the existing financing staying in place, and you actually close into a land trust. So if a bank comes, and the land trust should be the property address, so like the 123 Walnut Street Land Trust. So if a bank if they're doing an audit and they see that on the notes that they hold, title transferred, and they see, okay, so Mary Jones transferred the asset of 123 Walnut Street into the 123 Walnut Street Land Trust, and the tax mailing address is still the same, it's the house, then they're going to think, all right, well, that was probably estate planning, and they'll move on. So it's unlikely that they'll dig in deeper as long as the payments are being made. But usually if payments are being made, then they don't care anyways. The other thing that I may have put this in notes. I'm getting ahead of myself, but so the disadvantages to the seller, so the risk is really limited. I mean, the seller, even if they do have equity, they don't have to give the equity away. They can sell the house. If let's say it's that same scenario where they bought it for 150, and instead of just letting them take over the payments and pay 100, they could they could sell it for 125 with $100,000 note in place. So the seller would get some of their equity, and then the buyer would pay off the note. So that they get a chunk of cash so they can run away, and they get relief from all their debt service obligations. Notes on the buyer side. So the seller is risking their credit. They're basically letting the buyer borrow their credit. This loan will remain on their credit. It will impact their credit score. The good news is the buyer can say, well, listen, you're not going to be able to pay your bills, so your credit's going to be destroyed. I'm going to pay your bills, so I will actually be rebuilding your credit score, not my own. Like, that's an advantage to you, is it not? So just understand that the buyer knows that they're in control of another person's credit. So they shouldn't, they need to take that seriously and make sure they understand it. Every one of these that I put in place, I insist, like, I get an authorization to release signed by every seller, just like I would on a short sale. And that allows me to contact the lender and arrange to put a third-party servicing company in place. And you can do this. It's like $11 or $12 a month. But so each month, a third-party servicing company will electronically pull the funds from the buyer's bank account and pay them. They'll pass the seller, and they pay that directly to the loan servicing company. And then the seller gets a receipt, the buyer gets a receipt, and I get a receipt, or whoever you need to gets a receipt. And you can get a hard copy in the mail as well as an email. So that way everybody knows this deal's on track, and everybody knows that, because what you don't want to do is set it up where the buyer makes payments to the seller and the seller makes payments to the servicer. Because what happens when that seller runs out of money? He takes the buyer's check, and he's getting, like, you just don't want to put them in that situation. Take the temptation away, roll it into a land trust, so it's protected. You've mitigated that risk, and then have a third party servicing company, your attorney be the trustee on the land trust, or your company be the trustee. Obviously, the beneficiaries are the buyer and seller, or buyer or seller. But and then put that third party servicing company in place. And that's the best you can do to really mitigate risk on both sides of the table. You might not see, as you dig into this, you might not see other people teaching it with those, specific things. But the land trust and the third party servicing company is something that I just felt like, after learning about this, I'm like, yeah, I could do a better job than what I read about. So those are things I put in place myself just to make sure if I ever found myself in a courtroom defending my actions on negotiating a deal like this, I think it'll be clear to the judge that I did everything possible to mitigate risk for both parties. A wraparound mortgage. So these aren't real common, but if a seller needs to get to a certain dollar amount, might get a full retail price, or if there's a small first mortgage that's almost paid off, and the second place lender is willing to loan the bigger LTV. So it's kind of like combining the subject to and second mortgage strategies. And again, the government loans are assumable, but most buyers aren't going to qualify. So instead of assuming it, you would take it subject to that loan staying in place. You just don't necessarily, you don't contact the lender and apply for assumption. You just take it subject to. So this would be for a buyer with limited cash who can't qualify for any other loans, or they just don't want to qualify for conventional or traditional financing. It's a seller who wants relief. They need a fast solution, but they're willing to hold. They don't want to give up their equity. They spent years paying on this house, so they're not going to take a deep discount, but they've been sitting on the market and they haven't been able to move this house. The advantage of the buyer is they can get a higher LTV, so they could potentially get 100% financing here without any of the costs or underwriting requirements of other loans. And then the seller can get their desired price by a quick closing by sharing in the risk. So again, this is another one of those shared risk scenarios. So disadvantages for the buyers, hardly any. Most loans aren't going to be assumable for this type of buyer. So there's a risk. There's still a risk there that if the first lender finds out that this hat transferred this way, then they could trigger the due on sale cause and call that note. The good news is if you're going to do this, chances are the first is smaller than the second. The seller is taking the disadvantages. They're risking their credit by letting the borrower borrow that first note until they can satisfy that. So from the buyer, it can be tricky to find a second note. There's a lot more risk being in that second position. So they should expect that they're going to pay a higher rate for that, because if you've got a first, and actually something I didn't put in here, I've been in this position myself as the lender, and I've been able to subordinate first position lenders. Now, why the hell they do it, I have no idea. But I wrote a $48,000 private mortgage on a rental house on a 5-year term, and there was already a first in place, and they owed, I think she had like 65 on a first, and this house was worth like 130. And I'm like, absolutely, I'll give you the money for 5 years at 15%. That sounds like a great deal. However, you need to get your lender to subordinate, and I want first position. And she's like, well, how do I do that? I'm like, I don't know. But if you want my money, it's only lent in first position. So to my surprise, within a couple of days, like they had actually subordinated their position. So I recorded in the first position, and the lender that was in first subordinated to second, even though their note was higher than mine. And I had no clue why the hell they did that, but it is possible because I've done it. So you can do that and show them how, like, you can show the second lender, whoever that is, whether it's the seller or another lender, if they insist on a first position, don't assume that you can't subordinate that first, because I've been able to do it. I would probably have not even think to bring that up had I not had the experience, but I did it. So these are best for, a late term first mortgage that has a low loan to value. So the seller has paid off a lot of it. The notes on the seller side, if the seller can't get the first off their credit if buyer can't qualify. So yeah, if that's the risk that the seller is carrying, is they still have that original mortgage out there that's on their credit. And if the buyer can't get themselves into a position to refinance, then they may have to carry that, whatever the term was, to the balloon or the end of the term. Next, this is one of my favorites. I actually love lease option. So this is a lease with option to purchase, oftentimes called a lease option. oftentimes marketed as rent to own. So lease option is a reckless, not reckless. It's an okay marketing term, but it's important you understand how to structure these. So this is a great low risk alternative to a subject to or a wrap. It's a lot less. It takes a lot less commitment, and it's a lot easier to unravel, especially, and it keeps you out of a courtroom. So in an environment like this, it can be a really great tool. Seller is going to get immediate debt relief through the option fee and the rent. The buyer gets immediate possession, and you have a closing happening at a future date, typically sometime in the next 3 years, whenever they exercise the option. So for a buyer, this is for buyers who have saved up money, and they're ready to close and move into a home, but they just can't get qualified yet. But they don't want to move. They want to move one more time and be there forever with their family, so they can quit moving around all the time. For sellers, this is for sellers, usually sellers who they really want to maximize every dollar of equity. A lot of times that's in a falling market or if they're slightly underwater. So a buyer will be comfortable to pay a future price. They'll pay a premium or even pay an above market price. There's no appraisal done, so they're okay to do that as long as it will appraise when they exercise their option. I have actually sold these with as much as 10%, like the homes being as much as 10% underwater. Now, yeah, I heavily disclaimed that and made sure everybody signed disclosures, making sure, like saying, we fully understand the risk here, and we understand that this is one of the few options other than a short sale, and we accept all the liability for our own decisions or accountability. But I've been able to put these together, like the purchase price was 110% of market value because it was on a 5-year option agreement. So the buyer was going through a divorce. In order to have his kid, he had to have a house, and he had to have it in it. Like he waited too long, and he called me. I'm like, man, we can't close a deal that quick. I can probably get you in a lease option if I can find a guy that's underwater that needs to sell. And he's like, just see what you can do. So I went out, and this is in an environment where, listings were like our supply was huge. So I just went out and found a house that was marginally underwater where they would have had to have done a short sale or just continued paying the payments. And I said, hey, I've got a really responsible guy. He's got, I think we gave him 5% as the option fee or 6% as an option fee. And we paid him a market rent. And I said, but let's just put this, because of your value, to protect him, to put it at a 5-year option fee with a renewal. Like if the home won't appraise in 5 years, then the 5-year period automatically renews for no fee. And I think I built some other credits in there. So I mitigated the risk as much as I could. I basically gave him an unlimited amount of time. He would never have to lose what he committed property if it wasn't appraised. I can maybe look that contract up and remember exactly how I did it. But this is a great tool to get people, buyers who are being told they can't buy, that they have everything. They have that desire to be a homeowner, but they just can't get there because the banks won't let them. And it's for sellers who want a fast solution or don't want to do a short sale because their credit's important to them, but this is a financial drag. This can be a really good tool. So the buyer advantages, they can lock in today's price and control the asset for the entire term of the option. Now, if let's say they lock in a price at $250 today, and all of a sudden the house is worth $175 2 years from now, will have to exercise their option. They can bail on the deal, and the seller got his principal and interest pay. Seller got all his debt service paid, all the property maintenance was taken care of, and he just gets the house back just like a landlord because the option dissolves and the lease is over. So there's no judicial recovery or anything like that. The other advantages to, a lot of buyers, one of the huge reasons that people do this is they're just sick of moving. They've lived in 2 or 3 houses over 5 or 6 years, and their kids are growing up and have more stuff every day. And they just don't want to go through that again. They know it's going to take a year or 2 to get their credit cleaned up after a divorce, and they just want to move into a place they can call their own, even if they have to pay rent for a bit. The advantage of the sellers is they can get immediate relief from all the cost, all the responsibilities, the maintenance, everything. And it's a very easy remedy. It's very easy to clean up if the buyer defaults. You're not looking at a foreclosure, you're looking at an eviction, because this is a lease and a separate option to purchase. The option to purchase dissolves the second that the first day that rent is late, the option dissolves. The way we write our options, like if you don't live up to your obligations, this whole thing dissolves and you revert to a landlord-tenant relationship. Your option fee, not your option deposit, but an option fee, is you have no access to it. This is another thing where I have very detailed checklists where the buyer sits in an attorney's office, and this is a notarized document, and they go on the list and check, like, you understand A, B, C, D, E, F, G, all these terms that you're agreeing to. You understand your risk. You understand your exposure. You understand what happens if you don't do what you say you will. And they initial each and every bullet point. They sign, and that gets notarized and recorded against the damn deed. Because the last thing I want to do is be in a courtroom answering for this when someone says, well, he didn't tell me that. And so I've taken this so far that, like, I do closings in an attorney's office, even though it's a lease with lease option. We can talk more about that later, but so the disadvantages to the buyer, mitigate risk by clearing title and holding in a land trust. So one of the disadvantages to the buyer here is that it's the same. I don't know why I put this under disadvantages the way I did, but so one of the things the buyer has to consider is what happens if I put all money into the property under a lease and option. What happens if the seller gets himself sued and that asset gets drug into the lawsuit and it's no longer his, and, like, no one cares about me because I had signed an agreement with him, but he held the asset and he doesn't have an asset to match the agreement. Like, where does that leave me? So the best thing you can do for them is require the seller roll the asset into a land trust. The same thing I showed you earlier. And then the option fee, one thing you want to make sure of for your buyer is that the option fee is credited back to the buyer at the closing table. If they do what they promised, then they should be entitled to that, in my opinion. Because of Dodd-Frank, I don't do rent credits. I don't mess with it. That was something, it's a contentious point, and I think it creates a whole bunch of liability, and it's just not worth it. What I would rather do is have them pay an option. I'll take a minimum 4% option fee. When I was doing a lot of these, FHA requirement was 3.5%. I rounded up to 4. I'm like, and the way I would sell that to the buyer is, listen, you do want to buy a home, right? Okay, and you realize you're going to have to bring some money to the table. So, and to make sure that money is at the table when you get your credit prepared, what I'm going to do is take that money now, because you're telling me right now you want to own. Okay, so we're going to take this 4%. That's an option fee. Now, what's important about that is if you don't do what you promise, that fee doesn't come back to you. If you don't close on the real estate, you never get a credit back for that fee. But you're telling me you're going to close. So when you close, this will be on the settlement statement. You'll see this 4% credit, and you're going to give me 2 months bank statements and 2 months pay stubs. And we're actually going to source this, and I'm going to send it to the lender right now. So in 2 years, when the underwriter calls and asks the originator where this 4% came from, he's actually going to have proof, because we're proactively taking care of you. And I have done this. I have a 95% close rate on lease option. Nationwide, there's a 15% close rate. Because I do these extra things and because I structure them this way, it feels like a home ownership. It feels like an actual real estate closing. Excuse me. Incredibly good success with these. So the option fee is from the seller side. The option fee is absolutely not non-refundable, and there is no rent credit. That way you're Dodd-Frank compliant for sure. And the seller is going to hold title. So if the seller's holding, seller holds title, that can be a liability. Oh yeah. So it can be a liability for the buyer if the seller is holding title. That's why we recommend the land. So the notes on the buy side, the seller's got to carry the risk until that buyer can qualify. So make sure the buyer has a clear plan for getting financed. The way I do these, I take an application. So I take the 1003 mortgage application and I charge them $35. That $35 pays for a credit, criminal, and sexual offender background check. And then I'll go to the seller and I'll say, here's the person we have 4% down. They have a clear background check and they can move in on this date. How do you feel? Are you comfortable with this one? Great. Then I'm going to move this over to my attorney's office. I'm going to have her prepare the land trust documents. We're going to take the home out of your name, roll it into a land trust. My company will be the trustee. So if you try to screw him or he tries to screw you, then I step in. And as the trustee, I can referee. Otherwise, my attorney will be the trustee, but neither of you are. You guys are the trustor and the beneficiary, not the trustee. We clear title. We agree to the contingencies in the contract. If there are inspections, we get the inspections done. We clear those contingencies. We document that. We document where the 4% came from. This all gets put together in a package and sent to the lender that they're going to commit to use at the end when they exercise their option. We make them go pay for professional credit repair, and eventually they call and they're like, "Oh my God, we're ready. Joe said I can qualify." So we'll give them a free appraisal. We reimburse them for their credit repair. We give them their option fee back, and we close it in a typical real estate closing. But that first closing, they sign the lease and they sign the option to purchase. They're bringing that money to the table. They're signing everything. It feels like real estate closing, and then we're recording that again. So we record it as a land trust. It's so everything's done in an attorney's office. Everybody has copies of their documents, including the lender and the credit repair guy, and everybody kind of worked as a team. And that's why my closing rate is so high on these, because I treat them like I have a high level of customer service, and I only put people in these who benefit from being in these. I see a lot of people do these. I call them truck hood lease options. I have heard from so many people who got screwed doing this because they're after they look at a rental property, they're standing out front, leaning against the truck, leaning on the truck hood, signing a lease. And the landlord says, "Oh yeah, you give me an extra $5,000, and then I'll let you buy this whenever you're ready." Well, they'll give them the first month's rent, the last month's rent, $5,000, and they get a copy of the lease. There's nothing in there that says it's an option. Well, then all of a sudden, a realtor shows up putting a sign in the yard, and they're like, "What the hell are you doing? You can't sell my house." And they're like, "Is that your house? This is John Doe's house. I just listed it." And then the buyer calls John Doe, and John Doe's like, "I don't know what you're talking about. You just rented that house." And they have no proof. And that unfortunately happens all the damn time. And there's a special place for those people. But so that's, you got, like lease options can have a bad name in a lot of markets. But if you do them correctly and do them responsibly and ethically, it can be an amazing tool to really keep markets moving and help people, really get out of a really bad financial situation. So I'm going to jump to Q&A. I have not been keeping an eye on this, guys. So let me, I guess I can stop the screen share for now. Get everything in one place. Okay. So Carolyn is here. Carolyn, let me find my attendees. We'll have Oh, there you are. Hey, Carolyn, you're on the air. Looks like you may be muted on your side. All right. Well, this might not work. Not everybody has a microphone. So Carolyn asked, Chad, how do realtors collect commissions with owner financing? It really depends on your broker. So whatever your broker's comfortable with, some brokers will actually be comfortable, like in the last scenario, the lease with option to purchase. If I do these as an investor, obviously I'm getting paid up front on the option fee. If I'm doing it as a consultant through my investment company, then we'll actually we'll establish the agreement. So we'll have our own option on the estate, and then we'll go out and find a buyer, and we'll actually make our agreements with them, and then we'll exercise our option and then assign that back to the seller. And I know that's complicated. It's in time we have, it would take me quite a lot longer to explain all that. But you can do it as an investor, you can do it as a consultant. But if you're doing it on your license, sit down and ask your broker, are you comfortable paying me the full commission on this, knowing that it might not close on a lease option. But if it's an owner finance deal, you have a closing, and the title transfers in most cases. So you should be able to take your commission. So if if you represent the seller, you list it at 6%, and then you appoint your broker to represent the buyer and designated agency, and you guys close this transaction. Let's say you do a contract for deed. The title doesn't transfer. The transaction closes, and that note is recorded the deed. At that point, you should have a closing, so they should owe you a commission. And if they're getting a big down payment, then obviously you're paid from that down payment. Excuse me, guys. All right, next up. Yeah, that's a good, Ramesh, that's a good point. That's why I did the session I did last time. So let me find you here. I don't see you. Ramesh said, would you agree that educating sellers about the note investment industry helps motivate them to carry a note? Most people I've met don't know that they can sell off the note or a portion of it later. Yes, there's a couple things can help motivate your sellers right now. And as I said, this is a professionals market. So if you're professional enough to understand this stuff and you can explain it to your sellers and you can show them how it's in their benefit. So what Ramesh is suggesting is that you make your sellers aware that they can write a 30-year note at 5% interest, and then they can take that note to the secondary market and sell it. They can take it to a real estate investor street and sell it, same way that servicing companies are like an originator. So they can actually sell a note and get their money now. So let's say they have $100,000 note, they'll sell it off for $80,000 to have that cash in hand, and that investor gets a 20% discount in that, and they'll make that up over time with the interest rate. So they can sell them. The other thing is, if you're going to if you need to be, if you're going to influence your sellers into using tools like this, you need to understand the headwinds that the lending industry is facing right now. There's some good videos out there. I mean, the reason I did the session 3 the way I did on Monday was to kind of help you guys understand exactly what's happening behind the curtain, so you can relay that to your sellers. Because most sellers, they think, oh no, everybody's title company said everything's fine, and whenever it is fine until it's not. And so helping them understand that values are likely to go down as the lending environment conditions degrade. Like the scenario that I said with Rhonda, I believe her seller has a lot of exposure and downside risk in not closing this week. So I think it's in their best interest to get it done however they can. So be able to educate your sellers on note markets and why these seller financing tools can be so useful right now. Alan, I probably should have talked about that in the beginning. Alan said, hi, Chad, I joined a little late. Are you discussing some of these creative financing strategies from the standpoint that we, all the lead members, are in the role of the real estate broker or as the real estate investor? In other words, are we the end buyer, investor, or are we the middleman trying to find an end buyer or rent to own tenant? Yes, Alan. I mean, you can do these as an investor. You can, like, as the principal. You can do these as a buyer's agent. You can do these as the listing agent. You can do these even as a consultant and just play a role in. You could do it as a limited agency. through on your license, or you can do it as a consultant through your investment company. I've done them all sorts of different ways. It's usually starts with what's your broker comfortable with, and then I'll tell you what you need to do as a consultant or in a limited agency capacity. Soledad said, how does a new buyer put insurance and pay taxes on the subject too? So what I do is I will just when I get the authorization to release, that allows me to call the lender, and I can call and say, listen, I just want to let you know, switch the insurance company. It's actually now Allstate, and Allstate is gonna, they'll give them the policy number and they can pay Allstate. The other way you can do it is if there's no escrow on it, then you just take that responsibility on. You make sure that the tax, the seller will have to do this for you. You can make it a condition of closing that the seller has to change the tax mailing address to your office address, so you get the tax bills, and you can make the, well, actually, no, that's not right, because the title transfers, so you get the tax bills anyways. But on the insurance, like I've done this where I just called and gave them I bought insurance on it the day before closing, used my authorization to release to call the lender and say, hey, can you replace the insurance policy with this policy number? And then they'll contact them and take care of it that way. Who can write the loan documents on a for sale by owner? Soledad, let me see if you have a microphone. All right. Are you there, Soledad? There you go. Oh, it says you're unmuted, but I can't hear you. I think you're asking who can actually paper these deals on if it's a for sale by owner. Like it depends, like whatever your role. Like if you're trying to, you said who can write the loan documents on a for sale by owner. An attorney, a real estate attorney. If there's no real estate professional involved, you can have an attorney write up the note and the deed of trust. Bill, some lease option experience. Hey, Bill, you're unmuted if you'd like to talk. I know you had a lot here.
Hi, can you hear me?
I can hear you well.
I lost you for a minute.
Yeah, I can hear you just fine, Bill. So tell us about your sandwich lease option strategy.
No, I like the lease option because for me, it's be able to control property with little or no effort. And generally, I do them when I have a buyer that I can't put into a property and otherwise, where you mentioned a divorce, and that's a very good market if you can find them, is because unfortunately with the divorces, generally the only one that benefits from the divorces are the attorneys. And I've got one right now that I can't find her property because she has to remain in a particular school district, and that's the only problem. But I prefer to do the sandwich lease options where I make sure that the option fee is higher than what my commission would be, and that works out really well with listed properties that are overpriced. Because most of the
But you're doing this as an investor, not with your license, correct? If you're sandwiching?
No, I'll do it as an investor, but I disclose to them that I'm the person purchasing it, or my LLC is, but I'm representing the LLC.
Yeah.
And I've never had an issue with that. The only problem that we run into is most of our title companies will not close in a land trust.
Really?
And I will ask the listing agent, if they have no experience, let me present the offer with you being present so that the seller understands what we're doing. And I always emphasize that it's a fee that's not refundable under any condition. So
yeah,
always have that money It's not like other ways where you can negotiate in a lawsuit what that down payment was. And generally that goes over pretty well, but before I present that offer, I always make sure, if possible, that the person that I'm going to lease the property to is going to give me an option fee greater than what I paid. In addition, that I'll have $100 or $150 or more in a spread as far as the rent. So I'll make a spread on the option fee, and then I'll make a spread on the rent payment. And then I always try to make sure that there will be at least a year difference between my lease option and then the option that I get to the renter.
Yeah.
So that
And
gives me
just so, Bill, there might be some people in here that aren't familiar. I want to catch up. So what we're talking about is sandwich lease option. Let's say Bill has a home and he wants out, but he can't sell conventionally for whatever reason right now. So Bill's going to go to him and say, I'll give you $2,000 and for an option to purchase, and then I want to lease this house from you for $600 a month. So the seller is like, whoa, that makes my mortgage payment and I get $2,000? Yes, I'm going to Vegas. And they're gone. So now Bill has control of this house for a 2-year period under an option, and he's already invested $2,000 and he owes $600 a month. So if he can go one going through a divorce and self-employed that has credit issues, that they can afford it, and that in 2 years their picture should be better. Then he'll go out and he'll take a $4,000 option fee from that person, and he'll enter into a second lease with option purchase. So he had a sublease clause in the lease he negotiated, so he has the authority to sublease to anyone, to sublet to anyone else. So he gets an option fee for $4,000. So he gets original $2,000 that he risked is already paid back. He gets $1,200 in rent the first month, the last month. And so that tenant moves in. So he takes $100, pays his he rents it for $800, let's say. So he's got a $200 spread on the rent every month, that arbitrage, and he's got a $2,000 arbitrage on the option fee, and he's in the middle. Now, if the market shifts during that 2-year period, that buyer disappears, ends up destroying the house, whatever it might be, he's responsible for repairs and maintenance. But ultimately, if he defaults, then it comes back to Bill, and the risk he has is he's responsible. If he doesn't, usually these go well. The buyer will exercise their option. That what comes back, Bill can exercise his option. You have closing, and he arbitraged and basically created money out of thin air. And he created a scenario where a seller could get out and a buyer could get in when everyone else was telling them they couldn't. Those are a little more complex. I don't use them because I open mail like once every 6 months, so I don't do well with the intricacies of those. But they're really neat tools. So anyway, that's what this sandwich lease option is. We didn't cover that, so I just wanted to be clear everyone knew what we were talking about. Bill, why won't they use a land trust in your market?
Am I muted?
No, we can hear you.
No, okay. It's just the preference of the title companies. And I believe North American Title is the superseding title company that our local companies go to.
It's tough. Actually had to go. I've had to train attorneys on how to use these because they're like, well, I've never done that. Are you sure that's legal? I'm like, well, yes, it's legal. It's a legal entity. Right. And I've had to actually sit down with attorneys and walk them through it. And I write a lot of my own legal paperwork, and then I have them go through and edit and approve it. So on this creative stuff, I wrote all my own lease option stuff and everything. And then I had 2 different attorneys look at it, shoot holes in it, and make it theirs. So I'm not practicing law. I have found the same thing. I've found sometimes challenging to find people who understand these unconventional instruments. But you might look at going to an attorney instead of a title company. Can you do that in your market? We
generally use title companies, but I do have a very good real estate attorney. Yeah. Even though I use our state approved forms for lots of things, if I get involved with a probate deal or a sheriff's sale, I will generate the forms because I've done them so many times that I will still pay the money to my attorney to have him review it and see if I haven't made a mistake or
Yeah.
if there's something new that he would like to add to it. And it's always, to me, it's always well worth the money. Back in the day when we did the
Absolutely.
earlier sandwich lease options, what we could do is structure it that the seller would pay any repairs up to $100, and we would have the new leasee pay the repairs over $100.
That's
So
how
me
I did
being in
mine
the
too.
middle, I never got stuck with repair, and we could do the same thing as what you were referencing was the rent credit. We would get maybe $200 a month credit as long as my payment was on time, and then I would give my client $100 credit. So it was a win-win situation all the way
Now,
around.
have you done that since 2011?
No,
Yeah, you understand Dodd-Frank made that illegal, right?
yeah, unfortunately for me.
Yeah. So
But
instead of doing credits, you just do rental arbitrage in that sandwich scenario where you owe the seller 600, but the guy's giving you 800. So you're getting credit, but the end buyer isn't. You can give them other types of credits on the closing statement, like I'll credit back their fee, obviously, and we give them free appraisals, free credit. We reimburse them for the credit repair they had to pay. Sweeten the pot that way. We can give things. We can pay for those things on the settlement statement.
yeah,
But credits.
we've never had a problem with that. The one clause that we do put in is that, say, 4 years down the road, when the option becomes due, if the market value has dropped as opposed to rising, then we have the clause that we can renegotiate the purchase price based upon a third-party independent appraisal.
Yeah.
And that usually works out well. One of my older ones lasted 6 years, and it went through three hands in the family. And finally, when we got ready to close, the heirs to the estate, they didn't like it. And they go, well, I'm sorry, but this is what your mother entered into 5 years ago. And they said they're going to have their attorney call me. And I said, well, better than that, why don't you have your attorney call my attorney? And then the next thing we know, they wanted to schedule a closing date. So that's where it comes in handy to have the attorney.
Right. Yeah. I've really been fortunate, and the worst scenario I've ever had in a lease option scenario was, he was a young kid. He's working in manufacturing. He had a fiance and a baby, and he gave us I think 6%. Like he wanted to put more down than we asked for the option fee. And I'm like, yeah, sure, if you want. I mean, that's great. It's there for you when you're ready to close. So he moved in. This was about $100,000 property. He plowed like $30,000 of material. He didn't have a labor cost because he did all the work, but he put like 30 grand in appliances, cabinets, countertops, repainted the whole thing, all new decks on the outside, outbuildings, like made it super nice. And then about a year and a half in, I get a call. And I was in the middle. I had done that one as a consultant, so I had assigned all my paperwork back to the seller and taken my fee. And the seller was like, "Hey, Jason's not returning calls." And I'm like, "Crap." I thought it was going to be these horror stories where the place was going to be trashed and he took all the copper with him. And not that he was that kind of person, but I get there and everything is, I mean, perfectly clean. There's not a single trash. The door was locked. No keys or anything. This kid, what we found out after 3 or 4 days of hunting a relative, and they were, I don't remember his back, but he walked away from everything because he lost his fiance, ran off with another man and his baby, and then he got fired from his job. And he was just so devastated. He was too proud to even talk to us. And he cleaned the house, cleaned up everything outside, left all of his stuff, like left the outbuilding and everything there, and just walked away. And we ended up selling the house for like 130 grand because he put all that equity into it and paid the principal down over that time period. So it's important that you put the right people in these deals, but that's my horror story. That's as bad as it gets for me in lease options. Now, there are certainly a lot worse stories that other people have, and it's mainly because they're putting the wrong people in there and they're not properly screening and underwriting. Well, Bill, thank you for letting us borrow your experience and expertise. Joyce says, how do I collect a commission on a lease option? Joyce, you need to talk to your broker about this. A lot of brokers aren't comfortable paying a commission up front. They want to put the lease option on file, and then when it closes, they want to get paid at the table, so that there's never a clawback or anything. So ask your broker how they would prefer you structure those. And sometimes they just won't want to do them at all. Oh my goodness, I got to roll through some questions. Sorry, guys. Okay. Drew says, can a realtor just get paid the first month's rent and also collect the commission? Yeah, that's actually another way to do it. So Joyce, further to your question, you can get a lease, which is sometimes equal to the first month's rent, as Drew suggested. And then so you have a lease and you have an option to purchase, which is basically a purchase contract. So you can take your leasing commission on your sales commission on that for brokering the deal. Thanks for reminding me. Said, Chad, where would you recommend investors get additional education on creative financing? So let me give you my screen back here. I'm going to show you guys a few things. Oh, I haven't given it to you yet. Here we go. So Bigger Pockets is an amazing place. If you guys aren't already a member of Bigger Pockets, you should be. You can be a free member, but if you go to forums and Bigger Pockets, let's say buying and selling real estate is the forum we're going to go to. You can also use this search bar. So we've been talking about lease options. So if you search lease option, what you're going to see is you have filters up here. So just under forum, there's probably a lot of good blog in the forum here. Over 2,000 conversations just about lease options, and some of these are as recent, as this past winter. And you can sort them by, let's just say, the latest. So these are going to be, here we go, today. There's new conversations coming in here. There's several from today. So anyways, Bigger Pockets is a great place to learn a ton. If you go to their bookstore, Brandon Turner actually has a really good book on, I don't know, see it here. This one right here. This has a lot of good information for more of these creative ways. So the book on investing in real estate with no and low money down. There's also an audio book of this. You can, but check out. I mean, this is becoming a Bigger Pocket, become a publishing company in the real estate space. Here's one on note investing that we also talked briefly about. But just go through these books, go through this for a ton of stuff, and then obviously on YouTube, there's lots and lots of conversations that have happened around creative financing. So, and then I think I had 2 suggestions for you, but I had another suggestion that has since slipped my mind. So, but so start out with Bigger Pockets. That's a great place to learn a ton about all these different strategies. Oh, Investopedia was the other one I was going to show you. So if you go to Investopedia, you can put in things like, just as remember the term. So this is not just a real estate investing resource, but they do have a lot of really good articles here. So you can search this and do like, Yeah, so they've got a lot of stuff on owner financing. So even though this isn't strictly real estate investing, it is a good resource where you can learn quite a bit. So check out Investopedia, check out Bigger Pockets, check out YouTube, and you should be off to a good start. Yeah, good question, Laura. So let me see if you're here, Laura. We'll talk about this. Laura Gray, you're on the air.
Hey, can you hear me?
I can hear you well.
Okay, great. Just wanted to get your take on seeing that employment obviously is increasing by leaps and bounds. And do you think that's going to lead to a deja vu situation like we had when there were so many foreclosures and short sales back in 2009, 2012?
You know, I wish it was deja vu. This time it's going to be more complicated because now we don't know what our recourse options are, right? So with the CARES Act being signed, now it's like, okay, so we know there's a mortgage forbearance for 6 months on a lot of these assets, maybe 12, but what does that look like? What's the law around it? Like, we've never been in an environment where we have such high unemployment and no real recourse for a period of time, and courts that are shut down, creating I don't even see how it's how we're going to clear the backlog after having courts shut for this long. So there's a bunch of variables at play. What's going to be different than 2008 through 11 is that these assets, the courts are going to be logged. I don't, there's are one more of a loan mod where they'll tack on the forbearance amount. It'll get tacked on the back, and they basically re-amortize the loan like a loan mod. Others are saying that it's basically just going to balloon in front of you. So it's going to accumulate in front of you. So it's going to, like, you'll go from not paying a mortgage to kind of hitting a balloon and then going back into your regular principal and interest. So there's so many uncertainties right now. It's hard to tell exactly what it looks like. What I think it looks like is a whole lot of nothing happens in the distressed asset space. Like as far as foreclosure and evictions and stuff, a whole lot of inactivity will happen over the next months. Then hopefully we've got some laws written and we've got some courts cleared where when we lift those moratoriums and the defaults do come through, we'll be clear on what a default looks like or how it's handled, or maybe they give the debt. Maybe the Federal Reserve steps in and says, all right, just like student loans, we're basically going to consider these payments paid even though nobody made them. You don't owe anyone anything. Start paying your mortgage again. Now that's unprecedented, but so is doing it for student loans. But that's how that's working. So essentially, for an undetermined amount of time, you don't have to make your student loan debt payments, and it will be forgiven. So whenever they say, okay, we're done, then you have to start paying again. So we're still waiting on a lot of those details to work their way down to us before we know. But there will be distressed assets. I just think they're going to come through the system slower. And one of the things that, just the sheer amount of people who are unemployed and small businesses that aren't going to survive is going to create a bigger problem, in my opinion, potentially a bigger problem, unless we come up with some solutions different than what we have already. But they're kind of like there's this jam. It's like the ice on a river. And until we start pulling some of those pieces out and it starts flowing through, I don't think we know exactly what it's going to look like this time. But I think there will be a lot of opportunity. I mean, there will be, unfortunately, default. But that's going to create opportunity for investors and short sale specialists. It just might be later this year, like late this year or in 2021 before we start, really seeing that come through.
Thank you.
Next up. Yeah, so Soledad was asking about trying to watch time, guys. I have got to go here in just a few minutes. I hate to leave questions unanswered, but I don't think I'm going to get to everybody. Soledad, yes, you can just take a standard listing commission. You can list the property and just sell it the same way you would with any other financing. Just on the contract, you say this is being sold with owner financing, and you can pencil in the details or make an addendum. Like when you prepare the purchase agreement, just check and if you're using a standard form, just say this is owner financing. See addendum A. And on addendum A, you can say here are the here are the for creating the note, here are the bullet points. And that, like when I write private mortgages, I send an email to the closing attorney. I'm like, here it is. It's a 30-year 30-year amortization, 1 year term, 1% origination, 15% interest, outside of the agreed upon term, interest adjust to 18%. Like I just bullet point out all the points, and then they actually write the note and deed of trust. So I don't have to be an attorney. So Alan asked if we have any ATL content in the archives discussing Dodd-Frank. I don't think we do. This is something that I really haven't been using a whole lot since 2013. We haven't had to because most people got back into positive equity positions. So since we really started archiving content for all the leads, there's not a whole lot there. Yeah, Wendy Patton. I forgot. So Bill suggested Wendy Patton's books, and she does. Joe McCall is actually someone I really like too. And actually, now that I think about it, guys, I think it was Soledad that asked that question. If you go to alltheleads.com, and in the top right, sorry, I'm moving all these windows around. Put in MCC ALL McCall, and that should bring up Joe and I. Yeah. Well, I don't see it there. It wasn't previewing the way I expected it to. So that's just a landing page. Go to YouTube, search Chad Corbett, Joe McCall, and we have that's one of the only things I've done publicly where I really kind of showed exactly how I do my lease options. It is this one right here.
Really glad you're here. We're in for a good episode.
So Joe McCall, I think, is friends with Wendy Patton. He was one of the people that I learned a lot from when I was first getting into this. And I'm trying to manage all these Zoom windows and drop you guys a link to this. Everyone in meeting there. So in the Zoom panel, I just dropped that link. Wendy Patton is the other one that was suggested. So I'm not sure where Wendy's selling her books now. She used to have, she still, it looks like the same branding. WendyPatton.com is where you can go to learn about the way she does lease options. And Wendy has a ton of great stuff. I learned a ton from her and Joe, and that's why Joe and I did the YouTube videos. I was just trying to contribute back to his audience because they taught me so much. But yeah, thanks for the reminder on that, Bill. Those are both good sources, good resources. So Matt says, when assigning a lease option, do I need to assign both the lease agreement and the option agreement, or do I go with a double close? So if you're doing it the way Joe McCall, like if the way it depends on what your role is, Matthew, if you're going to be a principal or not. Let me see if I can find you here. Hey, Matt, you there? I guess you don't have a mic. So, guys, I do want to be fair to everybody. I hate to leave questions unanswered. Dave, I think that's Dave Gwynn, that you have a number. You want to run through the wraparound mortgage. You're going to be in probate mastery here in 10 minutes. But I do have to, I hate to jump early, but I do have another training that we have probate mastery today. So I'm going to have to go get that set up. Kat will make sure that you guys get, this will be posted as a recording, and any of the links that we shared should be posted with it. Thank you guys for being here. I hope you learned a lot. I know that this is enough to whet your appetite, but not to make you fully prepared to go do this. But understand, and like in my position, I can inspire you and help you find resources to dig in. I can't really teach you everything about this in your market. When we go to the future sessions of This Shift Happens, I'm sure we'll have more conversation about this, and I can slow down and talk more about any ones that you guys are using in real time. We can help, troubleshoot deals in real time if you need that. So I'm going to run. Thank you guys for being here for part of Shift Happens. Tomorrow at 1 p.m. Eastern, we have the All the Leads Probate Mastermind call. And then Friday at noon Eastern, we will have another of the Shift Happens series. So thanks a lot, guys, and have a great day.